Hello. Hello, hello, hello. Hi, how are you guys? Hi, Eli. How's it going? Oh, you guys, I'm early and you're here ready to go. I love it. Love it. I love it. Say hi. If you guys do not say hi to me, I don't know who's watching and I don't know who's liking, and so I don't know that you're here. So make sure you stop and say hi because I like to see. I like to see who I'm talking to. So far, just Eli. That's okay. Oh, I got hair. Eli and I'll have our own little party. Um, hey, Mark. Hey, Reggie. Chad. Hi, Chad. I don't recognize your name. You're new to the. You're new. That's good. I like new people. And I like old people. I just like people. Hi, Micah. How's it going? Putting in winter week. Winter wheat. Texas. Texas. You just moved, Micah, right? Annette, hello to you in Tennessee as well. Hey, Steve. How's it going on your side of the state? Hi, Zane. Hey, David. Look at there. I got some North Dakota peeps today. It's getting dark. So now you guys don't have anything to do but tune in. So, yay. Okay. Well, we are here. We're together once again for our weekly review of the clients that I saw this week. And so we are going to start right on time today. If you have not said hi, say hi, because I'm going to check in a little bit later. But it was not a slow week by any means. But I didn't have any big, massive, major cases, and I kind of have, every week it seems like I have a theme. And this week's theme was young and just getting started. And I absolutely love that. It doesn't matter. I have clients that have thousands and thousands and thousands of acres. And I have clients that are just starting. And I've made a shift. A few years ago, most of my clients were the bigger farm operations. And today it's the little operations. And I think that I'm seeing that because of the fact that Working Cows podcast is a huge a huge thing with that, and then driving all those people here, and then as a small operation just trying to get started, and if we're doing more urban type farming stuff, there is not really an option for lending because banks don't get it. They don't want the risk. Get something a little bit different than the traditional methods. And so I am seeing a lot of those younger ones. Hey, Carrie. Hey, Steve. Everybody say hi to Carrie. If you call the office, she is one of the ones that's going to answer the phone, Carrie or Jess. So that's awesome that she's on. Okay. First client that I had that I'm going to go over, I guess not the first one that I had, but the first one that I'm going to go over, and this is our theme already starting out, non-farmers that is working off the farm. He is in his late 40s, early 50s, and he was farming, he was hay farming, he had some cows, and then the 90s came, and where he's at, there was a drought. And so he got out of it and has been back in the corporate world since then, so a lot of years. And now he's really just trying to plan the transition, right? So we're not going to have we're not going to like transition in 6 months. We're not going to transition in 2 years. We're going to transition over time. And he is looking at, I think his plan was like 10 to 15 years or something. He really wants to just have the cows and have all that set up for retirement, which is funny because, I mean, you all know farmers don't retire. But everybody else is looking forward to not doing anything and fishing, and he's looking forward to having cows again. So that was fun. And a way for him to do that is, obviously he's got his off the farm job and he's got money savings there. But he was contacted, he's got like 6 cows right now or something. And he was contacted by the Corral Panel people. And I'm not going to say the brand, but he is able to sell Corral panels and discount them 20 to 30% compared to the local farm equipment national store. And so that he said has been like, he was only doing it like 2 weeks and sold a boatload of panels. So if those of you that are out there ranching and wondering, what can I do to make a little extra cashola? And I'm in the middle of nowhere, apparently corral panels are the thing to do, and feeders and chutes and all those sort of things. So I was excited to see, I have not had anybody selling corral panels, and I just would figure you have to go to one of those stores to buy them, or a feed store or something that is selling them. But why not sell them? You don't have the overhead. You can discount it. You can sell it for a little bit less. So yay. The next one, I had 2, I'm just going to combine these two. 2 young guys, 21, 23, not married, no kids. They're both currently living at home. One of them is going to be buying a house. Okay. So they both come to me and say, oh my gosh, Mary Jo, I have all this money, right? Or I can put all this money away. And typically I go, oh, that's a little bit scary. We have to prepare for worst case scenario. And so in the one situation, and in both situations, I get it. I'm totally on board. It's not that I didn't pull back a little bit, but I'm not going to pull back as much as I normally do with these guys. And the reason why is because men can live in a shoebox. And as long as they have, and even I have some female clients too, very, very, if we are not married with no kids, we can save a lot more money because we only have one person to answer to. And very much like a couple weeks ago when I had the really awesome young man who was saving and all this good stuff, these guys are the same way. They want to save and put as much away right now as they can, and I am all for it. Do it now, and then if we have to back that premium down, we can do that, and we're going to know what that looks like based on their numbers. One of them has a whole bunch of money saved up because he's lived at home and he's just socked away every single penny for the last couple of years, and no student loans, so none of that had to be paid back. And so he has a large amount that we are able to put in year one. So can we put a little bit extra in year one? We can. And it's determined by how the structure of the policy is, your age, your health, all that good stuff. So for him, we're going to put a lot in year one. The one that is also buying the house, I said, well, are you going to do, they're both living at home. One's buying a house. I said, are you going to be putting 20% down for your mortgage? And he said, I don't know. I can go as low as 5. Okay. So then you have PMI. And he did not know what PMI was. Even though he works in a bank, he doesn't work on that side of the bank. But even though he works in a bank, he didn't know what that was. That just led me to ask, why do our financial advisors, why do our bankers not teach these people that? Like, this kid has double what he needs to put down on his house. Why are we not saying, no, go ahead and put that down? Why are we encouraging them and not explaining to them the difference between 20% down and 5% down? PMI insurance is mortgage insurance. I forget what the P stands for. It's mortgage insurance. And so if my lovely Holly is watching, I'm sure she'll tell me. But we don't, why, PMI, that's just lost. That's just lost money going to the bank. That doesn't go to the principal on your house. So put the 20% down. And then I said, are you going to do a 15-year mortgage or a 30-year mortgage? Well, he could afford a 15. And so stretch that mortgage out into 30 years so that if something bad does happen, we have the availability to make that smaller payment. If you want to make a bigger payment, great. More power to you. Not ideal. And I ran all the numbers and I did a podcast on this, you guys, a 15 versus a 30-year mortgage. It's on YouTube. I recorded my screen. So if you want to see the actual numbers, go to YouTube. The numbers will be there. And so it was awesome that he could afford a house. It's awesome that he can put the money away. It's awesome that he's tithing right away. His mom and dad have done a very, very good job of setting a great foundation for him. But it's really unfortunate that the bank is not explaining the difference between 20% down and 5% down. The other young kid that I had, I'm going to call him a kid because I'm old. The other young man that I had, he is not in the same situation as far as being able to put every dollar away. Why? Because dad passed away of a heart attack. The farm, they had dairy, had to file, was trying to avoid filing bankruptcy or had to pay the bankruptcy off. I think they had to pay the bankruptcy off. And the uncle was renting the ground. That all kind of went south. Not a good situation. Dad was really just trying to save as much of the land as he could. The stress of it, passed away of a heart attack. Guess what? No death benefit. And he said his mom and dad never really liked life insurance, and now they see the value of that. And so he and his brother have had to help pay some of those expenses for mom. Because we lost dad's income, right? And so he's not been in the same situation, but he is being super frugal and he is also able to put a bunch of money into a policy, and I'm not going to hold him back. Put it in. Both of these kids and everybody I talk to, they're not lazy. If they get into a situation where there's no money, they're going to go do whatever they need to do to make money. Okay, if you are lazy, you probably didn't even call me because you didn't even read the book and you don't really care about the money. But when my people that I talk to, they will do whatever they need to do to make the money to pay premium. And so even though their premium is going to be a little bit higher than what I would start for somebody in their 20s, it is not going to be out of reach, and the minimum is still going to be decent. Like I think the minimum is going to be close to like $3,000 a year. So that is still a doable premium. But if you're young and you're not married and no kids and you're working your buns off and you have a good job and you are bringing money in with not a lot of expenses, I am all for socking that away and starting that policy and getting that thing funded. Because I have heard more than once, I wish I'd have done this before I had a wife and kids. It's hard. Daycare is expensive. It is hard and expensive. It's hard to save money and expensive when the kids are little. I have another one that is, he's in his late 40s, another guy that is, or early 50s, another guy, him and his wife working off the farm. They've got, a few acres and they want to have some cows and they want to rent some acreage from somebody else and run some cows on that. And they did not grow up on a farm operation, but they want to get into cows. That one I thought was pretty funny, just because their kids all grew up with show cows, but not with cattle. But all the kids are in relationships, married or dating ranch kids. So it's meant to be. Sometimes it's meant to be. Let's see what else I got here. Hey, Erin. We are talking about whole life insurance. Carrie, private mortgage insurance. There you go. All right. The next client I have is, this was a mess. This was a mess. And this, parents, if you're listening, we want to put the farm in an LLC, right? And the idea is that we're going to transfer that LLC, and we are going to transfer it to the next generation. So in this situation, we've got 3 kids. So the LLC goes to those 3 kids, and they all own shares. But it didn't stop there. One of the now the in-laws got shares. So 2 out of the 3 in-laws have shares. 1 has more shares than the rest. 1 is running it. 1 just left because it got to be kind of messy. Another 1 stayed. There's a lot of feuding going on. Now the kids want to come into the picture. The 3 that inherited it, now we've got 6 kids, and at least 4 of them, the way it sounds, are going to most likely want to have something to do with it. 3 for sure. 3 to 4. So now what happens? What happens when the 3 that inherited it, those shares get split and get split and get split? And this is a great idea when we have 2 kids. And great, we want to split the shares, and we want everybody to own some. But when you're going to do that, and that's a great strategy for 1 generation, 1 to 1. But when you do that from 1 to 3 to 8, or whatever that number is going to be, you need to think long term about that disaster. I have yet to see one of those that does not turn into a disaster, because there's so many people and they all want their opinions heard. And now we're in the position of, what do we do? So she called saying we are in debt, and they have quite a, it's not astronomical amount of debt. They've done a great job of clearing it up, but her husband got ill and had to quit his job. So we are talking $80,000 a year, no longer coming into the house. Obviously they were going to have some sort of expenses, those sort of things. And so now she's like, well, what do I do to get the kids into the ranch because they want a ranch? The kids don't have any money. Mom and dad don't have any money. They're not on the ranch because the siblings running the ranch are running the ranch, and it's a disaster. Nobody wants to get in the middle of that. And so I'm like, really? Our option is what? For her to buy death benefit on herself so she can hand that down to the kids so they can maybe buy their own ranch or take over a ranch or maybe buy out cousins at that point. I don't know what the opportunities are going to be. All I know is that it's the only hope really that we have. The kids can find a great job too, right? They can find a great job. They can be entrepreneurs. They can do what they need to do to create that income as well. It is not up to her. However, if we want to give them a little bit of a leverage, we need to have some death benefit. And they had no death benefit on themselves. Mom and dad have nothing. He now has some sort of a brain thing going on, uninsurable, and he's diabetic, uninsurable. those kids need to get life insurance before they become diabetic because it's hereditary. And they should have not let his go. Times got really, really tough. And when things get tough financially, we struggle, right, with paying bills. And typically the first thing we think we can get rid of is the death benefit. Well, if we get rid of death benefit and we pass away, it actually makes it worse. Just like the young man I was talking about earlier. They were in dire straits already, and dad passes away from a heart attack, and now dire straits are even worse, and they lost the land they were very much trying to save. And so we really, please don't get rid of it. Do whatever you can to save that. I get it. I 100% understand. Sometimes it's just impossible. But if we want the kids to be taking over this ranch or doing something with this ranch, then we need to make sure that there's something there for them to do that with. But for the love of Pete, stop passing stuff down in an LLC multiple generations. It creates a massive, massive amount of issues, especially when you have people that aren't on the farm, or people that are on the farm and they're butting heads, and people are trying to create ideas and other people don't want ideas, right? Okay, Erin, you have like way too much there. I cannot even answer you. All right. Oh, the next one. Let's see. This was fun. This was a whole family, and they don't farm. Because you don't have to be a farmer, right? But this was a whole entire family, mom, dad, son, and daughter-in-law. They had a business together. So they have a business with the son and they have a business with the daughter. And everything was set up structurally like they should have. They have LLCs, personal LLCs that own the corporate LLC. And then they have a building that is in its own LLC rented to the business. And so everything structure-wise was absolutely fantastic. But no life insurance on anybody. And all this money is sitting in a checking account. Oh, we have liquid money sitting there not earning anything. And they pay cash for everything. They have no money borrowed for the most part. Pay cash for everything. And so that one is just a matter of getting some of that funneled over. So now we're borrowing it from the policy and we can lend that money to the business. And so the big thing there was, who's going to own that policy? Does a corporation own the policy? Do we own it personally? And we have to remember, whoever owns the policy is the one that's in charge. They get to change beneficiary, they get to change ownership, they get to take loans, all that stuff. So whoever owns it is in charge. If the corporation owns it, the life insurance company says the corporation needs to be the beneficiary. Okay? So and that's our company. That's the life insurance company I work with. They want, if it's a LLC that owns it, the LLC should be the beneficiary. If you personally own it, you can leave that beneficiary to whoever you want. But if you personally own it and it's meant for the corporation, the owner can change it outside of the corporation. And so now what? Matt, cash is not king. Cash is queen. Cash flow is king. Cash is great. But in this situation, we're doing what? We're going to save money, and then we are going to take it out of savings. And then we're going to save and take it out. And we're constantly dropping to zero. constantly dropping to zero, interrupting the growth of that policy or growth of that money, because we're interrupting the compounding. In a life insurance policy, we're not interrupting that compounding in whole life with a mutual company. And so that makes a difference. They are doing everything right by traditional standards. Absolutely everything right. One little piece and we can make it a little bit better. But we don't have any life insurance, so if dad died tomorrow, now what? Now the son has to take over and we have to mourn dad's death. If the son dies, the exact same thing. Mom and dad have to mourn dad's death, and dad has to have that company run all by himself. And so there's just some missing links there. On the other side of it, excuse me, they also have a business with the daughter, okay? And they are buying houses and then they're doing lease to own. And I absolutely love this idea. And I said, well, what got you started in that? Well, when they moved to the state that they're in, the bank wouldn't give them any money because they didn't have 2 years of work history. And so the person that they bought the place from did a lease to own. So they have built some credit up. In 2 years. They're going back and refinancing and borrowing the money from the bank and paying off the owner, right? So it's not a contract for deed necessarily, but we're just going to lease it for a few years. And so with the daughter, they have a whole nother business, and they've got many houses that they are doing lease to own on to give people an opportunity to get started when the bank says, nope, it's not happening. And out of all those properties, I think they had like 15 houses or something like that. And out of all those, only one of those lease to owns is not going so good. But if people know it's going to be theirs, they're most likely going to take care of it. I just really, really love the idea that they're helping people out to get started. Young people do not have credit. And it is hard for them to build that credit. And therefore the bank says, nope, we're not going to give you a loan. Well, I need the credit to get the loan, right? And so a lot of young people that I talk to do not like credit cards. They don't want anything to do with them because they don't want to get in trouble with them. And so they're not building any credit. They also bought mobile home parks, and then they are doing the same thing with the trailer houses. They're fixing them up, and then they're doing a lease to own on them. And they have a lot of those. I don't know how many, but they have a lot of those. And they own the trailer park, so then they're also getting the rent. But the vacancy was like 50% on these trailer parks, and now they're at 100% occupancy. And so they really turned it around, made it look nice. And I've heard of a lot of investors doing that, and I really like that idea. But you really have to know your stuff about mobile homes because they are not like a house. But it gives people an opportunity to get started. So that is what they were doing. But we just need to make sure that we have insurance on each other and we're crisscrossed, right? Dad owns some on the son and the son owns some on dad, or the business owns it, or whatever. Steve, yes, the business can own the policy. If the business owns the policy, it now becomes an asset of the business. And so, and if the business, and I think this is something that Aaron was referring to, I'm not certain, but I think this was something Aaron was referring to, is if it is an asset of the business, for liability purposes, it could be taken if there was any kind of liability, suing, lawsuit, or anything like that. Now, every state is different from what I understand in that department. North Dakota does not protect life insurance for the most part. Like, they'll just take it all. And so if the business owns it, we have to remember it's an asset of the business. I have some clients who actually set up separate businesses that just own the life insurance. That's all that they do. That's all that that entity does, is own life insurance. So yes, the business can own it. This is tomorrow's podcast, talking about the taxes. If the business pays the premium, it cannot expense the taxes. It cannot expense the premium. So there's no saving on taxes there. It's not an expense to the business. It's going to be a distribution to the business owner. Nate. Nate, you are not too late. Unless you're like 90. No. I'm kidding, Nate. No, it's not too late. You're only 47. Only. Oh my goodness. If you read the book, if you have, Nate, if you have this book, go to page 67. There is a comparison, young versus old. I address you old guys. You're not even old. No, it's not too late, but thank you for asking. And thank you, Steve, for answering his question. Okay, let's see who I got next here. Oh, this was interesting. I had a guy that was a life insurance agent and was trying to teach the infinite banking concept working with another agent. And this other agent wasn't necessarily teaching IBC. So you know how I always talk about people who try to teach this but don't know what they're talking about? Yeah, that's one of those guys. And so he worked with them for 4 months, and he's like, I had no idea. Like, he couldn't explain anything. He couldn't answer my wife's questions. And so I started reading books, and I have learned more from the Laura Murphy report, or from the Laura Murphy podcast. So he's been listening to Carlos Lara, Robert Murphy. They have a podcast. He's been listening to my podcast, and it sounds like any other podcast he can get his hands on, talking about the infinite banking concept. And so it was really fun to talk to him because I got all of his wife's questions answered, and she's like, yep, we're ready to go. But here's the thing. They have a lot of debt. A lot. And as much debt as they have money in savings. And I'm like, what? You have 15% credit card debt and 20% credit card debt, and you have money in a savings account? And she loves the security of having that liquid cash. And I 100% get it. I like liquid cash as well. But when we are paying 15 to 20% interest, can we take some of that liquid cash and pay down some of those higher interest rate credit cards so that we are able to get that a little bit paid off, take that payment and either apply it to the next one and do a little bit of a debt snowball, or use that and just pay that back into savings? Okay. And so I call it financial PTSD. When you are coming from a situation where you have no money and it has been stressful, anything related to money is going to make you hyperventilate a little bit, and you're going to be scared, right? You're going to get anxious about not having the liquid money. But just like they racked up the credit cards, if the liquid money is gone, they can just put it back on a credit card, right? I mean, unless you're going to jail and you need some bail money, chances are you're going to be able to put it on a credit card. And so saving some of that and having some of that liquid is okay. It was also very interesting because they had done their listening to Dave Ramsey and Susie Orman because their church brings them in. And he's like, it just did not make sense to me. When I read his book, he said you need $1,000 in savings and then you go chase these big rates of return, and it absolutely didn't make sense. And then I read The Richest Man in Babylon, and that made sense to me. Pay yourself first. And so more proof that if you're going to work with somebody on the infinite banking concept, Work with somebody that teaches the infinite banking concept and not some knockoff, half-assed theory of what they think it is. Because it is about the way we think. And he gets that now because he read Nelson's book. But this particular person didn't want to give up that knowledge, right? Just talked about retirement. Did not talk about the fact that we need to finance things today. And this young guy understood that. And so when you're listening to my podcast, when we meet, we're talking about financing things today. It's rare that I talk about retirement unless somebody asks me about retirement. A, most of my people don't retire. But B, we have so many things to buy before retirement when we're in our 30s and 40s. What's going to happen in another 35 years? Oh my gosh, who knows? I don't even know what's going to happen tomorrow. So we have to make sure that we are getting the information we need to understand what Nelson was teaching. He says in the beginning of his book, this is not a sales technique. And yet there are people out there using it as a sales technique. So be wary. Do your due diligence. Okay, and then I had another one. This is another messy family. We have dad farming and the two boys are farming and now we've got in-laws mixed in. And this particular in-law that called me said, you know what? I just don't want anything to do with it. Like, it feels like it's not going to be good. We're already butting heads. We just started and I don't want to be involved in it. So we want to buy our own land. Great. I love it when I hear that, because the sooner you can buy your own land or start renting your own land to get away from what you might inherit, you're building something on your own. So if it all goes south on the other side, fantastic. You're already got your own little world of farming built up. But what was interesting with this case is she worked off the farm. And so she has a bunch of money, and then he's going to the bank with the farm and he's borrowing money from the bank. And I said, why don't you just lend him the money? Because my money is not going to go to the farm. She said, my mom always supported the farm. We couldn't pay for XYZ until mom got paid. And I said, well, okay, but it's one pool of money. And I said, so he does pay the bank back when he borrows money from the bank. Yep. So if you lend him your money, he just has to pay you back. Oh, well, she's very hesitant about that. Like, she didn't trust him to pay her back, right? And this happened with the other family I had earlier. He bought $80,000 of land with cash, but they weren't going to pay the business back, but the business the business gave him the money. And I said, well, you got to pay that back. The business just gave that to you. You don't just give houses away. You need to lend that money to the son so he can pay it back. Same thing here. That's her off the farm income. That money is lent to him and then he pays her back. But they have this big pool of money that she's making, and guess what? He's going to the bank. And it's not necessary. Do we want to separate it sometimes? Yes. We absolutely want to separate off the farm income and farm income. Because if the farm can't pay for itself, why are we farming? We can't keep funneling off the farm income into the farm. But off the farm income can be lent to the farm. You just have to be an honest banker. Right? We have to pay it back. And Nelson talks about that in this book. So if we are honest, it doesn't matter where that money comes from. It will always be replaced to be used again. Even if you don't use life insurance and all you do is use a savings account. It's okay. But that compartmentalizing of money and separating money, we have to remember it all still stays in our house. We just lend it back and forth to the farm. And all you off the farm income people, lend money to the farmer. Lend them money. Charge them an interest rate. You start playing banker because you can. And guess what? If they don't pay you back, don't ever question the bank as of to why they wonder if they're going to get paid back. When we actually start lending money and having to question if we're going to get that money back, we have truly put our bank hat on and said, are you going to be a good borrower? Because if you're not, I don't want to lend you any money. Right? That is when reality hits of why the bank wants your blood and your firstborn child, is because they are questioning if they're going to get that money back. And in this situation, she was questioning the very same thing. And I have a lot of off the farm income people, off the farm, I'm just going to call them income people, right? That would not lend to their own spouse because they don't know if they'll get the money back. It is really, really easy to treat the bank better than it is to treat yourself. And if you are going to be borrowing money from yourself and using cash from savings, you need to pay it back. If you don't, guess what? You stole from yourself. No one wants a stealer and a thief. Okay. That is all I have for that's all I have for meetings this week that were big. I'm going to try to start sizing this down so that we don't go so long, because it seems like everything is just being very repetitive at this point. If it's not repetitive for you, let me know. But we have it seems like every week I kind of go through the same thing. And so I want to just kind of pick out the important things and then we can highlight those. Tomorrow's Steve, you are right. Discipline, discipline, and discipline. Tomorrow's podcast is about taxes. And do we get to is the death benefit income tax free? Does it grow income tax free? How does the tax code and life insurance meet? And that there are specific ways of using it. There is specific language. There is estate tax versus income tax. And so tomorrow's podcast, I go over that stuff. Because if somebody is telling you and saying, oh, this is all tax-free, it is not tax-free. It might be income tax-free. It might not be estate tax-free. Okay? It is all how you use the policy and utilize that money. It has to be done correctly. Everything has to be set up correctly. So tune in to that. If you guys, Christmas is coming, and if you are looking for gifts, then be sure to grab these. And guess what? This is audio. They're all on audio. So there's really no excuse for you not to be able to listen. Because they're all audio. Set up, and Steve said it, set up your appointment, get your book, read it, listen to it, whatever, set up your appointment, and then we can talk. I am not booking out that far. If you want to get in, and what we're going to do is an 1.5-hour meeting, talking about what is exactly going on with your operation. Why don't I come on here and give explicit details of how everything is set up? Because everybody's operation is different. I don't know what's going on with your operation. I don't even know what's going on with your family. And let me tell you, the family dynamics are pretty darn important. And so we need to meet, we need to talk about what's going on, and then we'll talk about how the policy is structured and how loans work and some strategies of how to use that in your finances, okay? Can we still draw on our 401k plans due to COVID? Steve, as far as I know, that is going to go until the end of December. That is what I have read. I don't think that they've changed it. Oh, hi, Winnie from Canada. Everybody say hi to Winnie from Canada. If you are Canadian, if you are listening to this and you're Canadian, you should reach out to Winnie Lau, L-A-U, Winnie Lau. She is a practitioner in Canada and she can help you. And yes, she understands some farming. So she can help you if you're a farmer. Okay. Guys, I think that's it. I don't have anything else unless you have something else. But I do appreciate the fact that you hung out with me again this week. I might start moving these to an earlier time because it's dark early now. And so everybody's, you're going to get done feeding a little bit earlier. Everybody should be in the house a little bit earlier. And then it won't go past my bedtime. Okay, if you guys need anything, you know where to find me. MaryJo@withoutthebank.com. I will be happy to answer any questions. If you have any comments, if you want to hear anything on podcasts, you let me know. Okay, guys, you have a fantastic rest of your night, and we'll see you next week.